Everyone believes the next economic shift will arrive loudly crashing markets, breaking headlines, obvious villains. But history tells a different story. The biggest economic transformations don't announce themselves. They creep in quietly, disguised as progress, stability, or innovation. And here's the mystery. By the time most people realize the system has changed, the winners are already chosen. And everyone else is left asking the same question: how do we miss it again? To understand what might come next, we have to rewind. Every major economic shift in history followed a familiar pattern. The Industrial Revolution promised productivity but rewired labor forever. The post-World War II boom built the middle class while planting the seeds of mass consumer debt. The digital age democratized information but concentrated power in ways no one fully anticipated. Each era felt permanent until it wasn't. At the center of these shifts were systems, not accidents. Banking structures, monetary policy, technological breakthroughs, and political incentives moved together like gears in a machine. Key figures didn't necessarily plan collapse or disruption. They optimized for short-term growth. And that's where the twists always begin. The origins of the next shift can be traced to the late 20th and early 21st century, when growth became a non-negotiable goal. Governments tied legitimacy to economic expansion. Corporations tied survival to quarterly profits. Financial markets learned to expect constant returns. To fuel this, debt stopped being a tool and became a foundation. Cheap money wasn't temporary, it became normal. The rise came fast. Globalization lowered costs. Technology scaled faster than regulation. Central banks learned they could delay pain by injecting liquidity. Asset prices soared. Productivity lagged, and inequality widened. But on the surface, everything looked stable. Growth numbers reassured policymakers. Stock charts rewarded investors. The system appeared to be working. Then came the breaking point, not as a single event, but as stress fractures. Wages stopped keeping up with costs. Younger generations delayed home ownership, families, and retirement. Entire economies became dependent on low interest rates, unable to function without financial life support. Each crisis, from market crashes to pandemics, was treated as an exception rather than a symptom. The fallout followed predictable lines. Wealth concentrated further as those closest to assets recovered fastest. Trust in institutions eroded as bailouts protected systems, not people. Productivity gains flowed upward while economic insecurity became normal for the majority. And yet, the narrative stayed the same. Just one more fix, one more stimulus, one more reform. Those fixes largely failed. Raising interest rates slowed inflation but strained households and governments. Lowering rates reignited asset bubbles. Regulation lagged behind innovation. Technological solutions promised efficiency but often replaced stability with volatility. Each attempt solved yesterday's problem while amplifying tomorrow's risk. This is where modern parallels become unsettling. Today, a small percentage of people control a majority of global wealth. Entire markets depend on confidence rather than fundamentals. Artificial intelligence, automation, and digital finance are accelerating productivity while reducing the need for traditional labor. At the same time, public debt levels in many countries are at historic highs, and trust in economic leadership is near historic lows. The pattern is repeating. Just like past shifts, the system is optimizing for speed and scale, not resilience. Just like before, the warning signs are visible but easy to rationalize away. And just like before, most people are focused on surviving the present instead of preparing for the future. So what does this mean? First takeaway: economic shifts don't replace systems, they re-rank people. The rules change quietly, and those who adapt early gain disproportionate advantages. Second takeaway: stability is often an illusion created by policy, not proof of health. When stability depends on constant intervention, the system is already fragile. Third takeaway: the biggest risk isn't collapse it, a slow normalization of instability until it feels permanent. The real warning is this: the next economic shift may not look like a crisis. It may look like convenience, automation, digital money, or efficiency. And by the time the consequences are obvious, the opportunity to prepare may be gone. History doesn't repeat because we forget facts, it repeats because human incentives don't change. The question isn't whether a shift is coming. It's whether you'll recognize it while it's still unfolding. If you want to understand how these patterns shape your future and how to think differently before the rules change, Subscribe to the channel, like the video, and stay curious. The next shift won't wait.